to give us potential to stay with the trade longer, but reduce our risk, reduce our theta, and have a great trade setup that we could still, sit with for even potentially bigger profit. So with the trade originally, so this is what I always like to do, and we talk about, and I try to teach all members and clients, is that when you set up a trade, especially using options, always think 2 or 3 steps ahead. Okay, so just if you like to play, cards, poker, or gin rummy or chess or whatever, you're always looking for the next move. You're looking for this particular card series or that, or you're looking for if XYZ, if he moves this, I can move this to chess move here to take advantage of what he's done. So we always look 2 or 3 steps ahead. So what we're looking at, we did the debit spread here. We're looking for a move down. So always have a target in mind based on Fibonacci or moving averages. So one thing we can do is, okay, so we set up a debit spread here. We're looking, okay, if we get it right, we have a move down. Now we can adjust and lower our risk when it's down at this point. So let's say it was at 100. Now it moved down to 95. So now we can adjust if we want, if we just know what to do. And this will adjust us to reduce the cost or capital at risk. Plus, we can increase or reduce our theta by doing this. All right, so this is what we did. So we originally had a put debit spread like this, and then when it hit down to a certain target area, we adjusted this into a put butterfly, reduced our risk super low, which then provided us potential for a huge return on capital, but we had our risk virtually down to 0. So very cool thing, but you can do this with options, nothing else. We'll do this for you. Okay, so this was the alert trade. This is kind of going through with you what we were looking at. So trade 1 was, we started out with that put debit spread on the 11th. It was traded at 298.30. So we had that 298 put, 290 put, debit cost 280. So that was our trade that we started with. And then trade 2 was, again, looking to our 3 steps forward, that we were thinking, okay, if it moves down, what can we do? So if it moves down, we were going to then sell a bull put credit spread. And so did that. It was trading now. It went from 298. It was trading down at 287, kind of in our target area. So when it's trading hard down here, we were able to sell short the 13 May 290 put, by the 282 put, brought in a credit of 258. So we almost offset that full debit cost here of 280 by this credit of 258. So now we ended up with trade 3. We have an adjusted long put butterfly where we're long the 298, short the 290, short the 290, long the 282. Now our total cost of the trade has gone down just to $22. We started with $280 of risk. Now we're with $22 of risk on this trade. So it's like controlling 100 shares. We're controlling that 100 shares, not for, 10,000 or whatever it might be, but we're controlling the 100 shares for $22. So, in this example, when it was trading down to, let's say 282, if we'd had 100 shares times 287, so we're looking at that risk would be like $28,700, okay, of risk. But in this situation, our risk is $22. So it's really incredible when you think about it. So that's the beauty of it. And let's go through this example here, and I'll show you how this thing worked out. So again, here it was. This was alert trade. You can see it says here. Here it says trade. Okay, may hold longer depending on today's price close, and then it says short. Then short the vertical credit spread when it gets down. So we would be looking to convert to a butterfly on any move lower to reduce risk. Would then look to sell the 13 May 290, 282. So that's what we did when it was trading down here at lower. And then we had a nice, huge profit take the next day on that. So let's go through and I'll show you the profile. So here it was, again, here was the put debit spread set up right here. Now it flushed down and was trading down here to trading at 291.78 right here. So we converted it to a butterfly when it moved down. This was all the same day. So originally had to put debit spread, had a big, huge flush down, allowed us then to adjust it to a butterfly, reduce our risk, and stay with the trade longer for potentially even more money return on our capital at risk. So when it spiked down, we were able to adjust it, and now we were then ended up long the 298 put, short the 290 put, and then long the 282 put. So we have an $8 wide spread on this butterfly, and look at the risk. So we have this 298, 290, 292. So we have this butterfly trade now set up. So $8 wide spread, $800. Look at the cost of the trade now. We've reduced it now to $22 by adjusting to the butterfly. Now this is what's amazing. If you look at the then return on your risk, look at the potential here. So this is theoretical, but this is how you calculate, would you want to do this or not? So if you look at this risk profile, you can see, okay, max loss here, $22. Max profit, $778. So again, this is an $800 wide spread, okay, that you did. Your cost on the trade, the way you were able to adjust it, was now $22 of risk. So your potential profit is the difference of $778. Okay, that's theoretical. You have to exactly hit 290 expiration, but that gives you an idea, and you're happy with anything in between. So if you can make 200, 500, whatever, look at the return. That's a 3,500% return if it was to nail it perfectly. So you can see that that's a, risk $1 to make 35. So you can see that of all the different option strategies that are spreads, this by far will give you the biggest return on your capital at risk. So shave down that risk to $22, which then you can sit back, no stress, and just see what happens. So that's a look there. Now, here's what happened. So here it was on the 12th here, is trading at 291.15. So it was up to $264. Okay. And that's a 1,200% return because you're up 264 and your risk though is 22. So just, amazing risk reward. So look at the potential here is huge though. So all that is still potential profit. But the main thing is we want our risk low. We want to be able to participate in the trade and then potentially make more. So this is one way to do it. So that was a really cool trade setup. And again, it's thinking one or two or three steps ahead.